The U.S. stock market is currently navigating a complex landscape where political maneuvering and institutional battles are proving just as influential as corporate earnings. For macro investors, understanding the sudden revival of the takeover trade and the brewing conflict over Federal Reserve independence is essential for charting the course ahead. This isn't just about quarterly results. It's a tug-of-war between policy shocks and institutional guardrails that will define the next quarter. The biggest story driving recent market sentiment is the sudden, powerful return of the takeover trade, an acronym for Trump always chickens out. This theory posits that while the president frequently initiates aggressive policy threats, particularly regarding tariffs, he often retreats or softens his stance when faced with significant market backlash. Crucially, investors must remember this is a market narrative, not a law of physics, and its effects are often exaggerated by extreme market positioning rather than fundamental shifts. This dynamic was illustrated when plans for new European tariffs were abandoned. The market's reaction was immediate. The S&P 500 recorded its largest gain since November, underscoring the market's deep desire for the removal of policy uncertainty. Investors are clearly prioritizing stability over aggressive trade posturing. While the tariff retreat provided a tactical boost, a more structural battle is unfolding over the independence of the Federal Reserve. The White House's attempt to dismiss Fed Governor Lisa Cook has escalated to the Supreme Court, igniting a debate about the limits of presidential authority. Central bank independence is the bedrock of modern finance. It anchors inflation expectations and ensures Treasury yields reflect economic reality, not political whims. Justices have expressed concern that such a dismissal could undermine the Fed's ability to manage the economy free from interference. This is a critical watch item because any perceived erosion of independence could trigger long-term instability in the bond and currency markets. The court appears to be leaning toward protecting the institution's autonomy, but tail risks remain. If the market begins to price in a politically compromised Fed, we face significant credibility risk. This could lead to unanchored inflation expectations and volatile Treasury yields, destabilizing the very foundation of monetary policy. Beyond the political theater, the real economy is sending signals through the energy sector. A severe cold snap across the U.S. has caused natural gas prices to soar, while the IEA revised its 2026 oil demand outlook upward. Energy prices are a direct input to headline inflation, and a sustained surge here could complicate the Fed's path to rate cuts, even if the political dust settles. This combination of weather-driven supply shocks and structural demand shifts has positioned energy as a top-performing sector. It serves as a reminder that the fundamental laws of supply and demand in commodities remain primary drivers of inflation and growth. Looking ahead, the market is entering a negative gamma zone. This technical condition implies that dealer hedging activities can significantly amplify price swings. In this regime, dealers are forced to sell into weakness and buy into strength, technically exaggerating moves in both directions regardless of the fundamental news flow. This makes the market highly sensitive to new information. This heightened sensitivity means upcoming data releases will likely cause dramatic reactions. Key points to watch include third-quarter GDP growth, which could fuel inflation concerns if too strong, and the PCE price index. The core PCE is the Fed's preferred inflation gauge. If these numbers come in hotter than expected, the recent takeover-driven rally could face a sharp correction as the path to lower interest rates becomes clouded. The key to navigating this environment is balance. Enjoy the tactical wins from policy relief, but stay disciplined on structural risks. Before we close, here is your checklist for the week ahead. First, monitor the Supreme Court's signal on Fed independence. Second, watch the core PCE print for inflation stickiness. And third, keep an eye on energy prices as a leading indicator for headline risk. Patience is paramount.